Hello everyone, welcome to simplefinancesupport.com Financial Accounting Concepts and Terms Fact Series. Today we would like to discuss about general ledger accounts. This presentation provides conceptual understanding of account, ledger and fundamental basis for financial statements. Let us try to understand what exactly account means. In every business, as we discussed in other sessions, there are a lot of business transactions, right? So these transactions may be financial transactions and non-financial transactions. Okay, example for the business transactions mean like investment into the business, payment of salaries, selling of goods, manufacturing of products, and so on so forth, right? So these are all business transactions, and most of the business transactions are resulting in the financial transaction. So meaning, if a business transaction has got a finance in nature, means like it is impacting the financials, so then these are the financial transactions. There may be some business transactions which may not impact the financial aspects of the business. For example, if CEO is having a general meeting, so then there is nothing like immediately having impact on the financial statement. Whereas if you are purchasing something from a vendor, then this particular transaction, this particular business transaction has got direct impact of the financial. So those financial transactions which are there will be recorded either a positive or negative way, which means like either it is increasing or decreasing the net effect of your financials, right? So that is something that we call as a debit and credit, right? So these financial transactions will have impact. So then when you are recording these transactions, then to record that particular transaction, that you are using some name, right? So that name of that record is what we call account. So basically, to define, account is a name given to specific record as per general ledger generally acceptable accounting principle or conventions and practices, and sometimes country regulations. So this name which is given to record financial transactions is what we call as an account, and this account records the transactions either debit or credit side of the account, which means like depending upon the type of account, depending upon the type of transactions, the impact will be either debit or credit. So account forms the basis for financial measurement. So anything that you are measuring, for example, how much revenue that you made, how much cost that you incurred, how much salaries that you paid during a month or during a period or during a year. So this kind of measurement can be done by recording the values from the business transactions into general ledger account. So that is what exactly the account means. Account is just in a name of a record. So let us look at like how account naming convention evolved. So for example, there may be some accounts which are generally accepted accounting principles based on the accounting principles you may be having. For example, it may be a US GAAP or Canada GAAP, right? Or any other country GAAP. GAAP is nothing but generally accepted accounting principles. So, like for example, account names like salary account, wages account, revenue account. So these are the accounts which are normally generally accepted everywhere, right? So that is the reason. So these are, like you can say that, like a common accounts which you come across in any business. So there may be some account names or record names which will evolve based on the conventions and practices of particular industry or the nature of the transaction. For example, if you look at like the type of transactions that are done, bills of exchange and letter of credit and factoring. So these are different types of accounts depending upon the type of conventions and practices followed. For example, in some countries factoring is allowed, meaning buying of receivables in advance is allowed in some countries. So that is the reason the factoring account may be available based on that convention or practices which are there, right? And in some countries it may not be available. In some countries, for example countries like India, you will use bill of exchange as a medium of payment. If you are not able, if the vendor is not able to receive like funds immediately, so then he can accept the bills of exchange and he can take that bills of exchange to a bank and he can get his funds in advance, right? That's what we call, he can discount that bills of exchange. Whereas the same kind of bills of exchange is not allowed in US. So letter of credit accounts. So depending upon the type of nature of the transaction and the practice which is there in that particular country location, so that based on that these accounts are evolving. And sometimes the regulations, for example, if you take withholding tax account is in US, the same withholding tax concept is called tax deduction at source, TDS, in India. Okay, and there are a lot of accounts which are related to nota fiscal in Brazil, right? So as we described, the account is just a name for a record, type of record. So but the names which are evolved over a period of time. So let us look at the business transactions and what are the types of accounts. Like we said, basically the business transactions can be segregated into assets, liabilities, expenses, and revenues. So assets are treated as real accounts. The even though it's account, but we call as a real account. Whereas liabilities mostly we call as a personal accounts, and then expenses and revenues are called nominal accounts. Okay, so this is another name given to the accounts. So let's look at these accounts. How do they play in the whole the ledger concept? Okay, so as we described, like accounts, there are like a lot of accounts, right? So in any organization given a period of time, depending upon the type of business that they are operating, it may range from anywhere from 1000 to 2000 general ledger accounts may be there. Okay, so all these accounts, basically, if they are treated as a page in a book, so then that pages which are combined into a book is what we call as a ledger. Ledger is book of accounts. Okay, so all these accounts that we talked about, right? So every account, if you are putting into a book and you're recording that in a book, that book is called ledger, and the general ledger forms the basis for financial statements. So which means all the accounts which are there, all the accounts for the for the company which is presenting the financial statements, all the accounts that you're having will be treated as the general ledger accounts, because all the listing of all the accounts which you are recording in this book is what we call ledger, and that is also called a general ledger. So then accounts normally referred as general ledger accounts. So because these are part of a general ledger, part of a book where you are writing these accounts, the values into these accounts, that is the reason very frequently an account is referred as a general ledger account. Okay, so when you refer general ledger account or ledger account or account, they are synonymous, like there is no difference between general ledger account and an account. Okay, so account is for recording the transaction values, and the book that you are having all these accounts in is what we call as a ledger, which is all the accounts that we are having, that is called general ledger. So in some other video I will explain about the general ledger and sub ledgers, but here for the conceptual understanding purpose, the general ledger is book which contains all the accounts which are used for recording the financial transactions. So general ledger, when you say the general ledger, so like every account you have a debit and credit, and towards the end of a particular period you will take the values in from the account and see which side is more, right? If the credit side is more than the debit side, it's called a debit balance. If the debit side is more than the credit side, then it is a debit balance. So, and the overall balances that you are having, you will be representing in a statement called a trial balance. So the debit balance will go to the debit side of the trial balance for the account, and credit balance of the account goes to the credit side of the trial balance, and all the accounts are represented in the trial balance, right? So which means in this case, let's say cash account, receivables account, office supplies, so like that, you listed out all the accounts, and the net balance of every account, either it's a debit balance or credit balance, that you are pulling into the trial balance, and towards the end the total value of debits are equal to credits. Obviously, we explained about the debit and credit rule, so there will be always a debit and credit impact based on real accounts, nominal accounts, and personal accounts. So the first check for financial accuracy is trial balance, where all the debits should be equal to credits. If not, there is some mistake made in recording of a particular business transaction in the account. So the trial balance is the first step towards preparation of financial statements. Financial statements meaning profit and loss statement and balance sheet. So I will explain about the trial balance and P&L statement and balance sheet in subsequent sessions. But up to here, if you clearly understand what is account and what is general ledger, how they are recorded, and what is a trial balance, how the values which are recorded the debit side and credit side of a trial balance from the general ledger accounts. Okay, so hopefully I made it very clear and in a simplified manner about the account and general ledger. Thanks for watching this video, and we are looking forward you to visit simplefinancesupport.com for more fact series videos and explanations. Thank you.